Hello folks, welcome to another session. Today I will discuss chart patterns. When you are having chart patterns in your trading arsenal, you are better equipped to make profits in these markets. The chart patterns will earn you lots of money because whenever the chart patterns appear, you will be knowing what is happening in the markets. These patterns appear frequently on the charts, and whenever they appear, they give awesome results for the traders. So we will start from the traditional double tops and double bottoms. So first I will show you double top illustration and its example on the chart. This is the first high the market made, and then the market was unable to break this high and made a double top. This area is called as a neckline. The double top is actually a reversal pattern, and the price is not able to break the previous high, and there forms a double top pattern. This is a strong sign that a reversal is going to occur because it is telling us that the buying pressure is just about to diminish. Our entry order will be below the neckline. We will be looking for this pattern at the top of an uptrend. So here the drop will be exact the same height as the double top formation. We will count it from the neckline to the highs, and we will take it again from the neckline to the downside. Let's say the distance between the neckline and the highs is 50 pips, so the market will drop exactly 50 pips. It can, but for us we will target the exact same amount of pips is from the neckline to the highs. Let me show the double top example on the chart. The market was in an uptrend. The market formed a high here and it came a little below the high, made neckline. The market was unable to break this high and it made a strong resistance point. It retested it for the second time and made a double top formation. So this was the neckline, and the distance from the neckline to the highs is 50 pips, and we will target the exact amount of pips is from the neckline to the highs, you can say to this point. And as I said, the double top formation is a reversal pattern. So we can see here the market reversed from an uptrend to a downtrend just after the formation of a double top pattern. So now we will be discussing the double bottom formation. It is the same as double top, but it works opposite, and it is also a reversal pattern. This area is the neckline, and the market will rise is the same point is from the neckline to the lows. Let's say the market has moved 50 points from the neckline to the low, so We will also target 50 pips from above the neckline. Our entry order will be above the neckline, or we will trade it on the neckline, then we will have to trade it, and our stop loss will be in the middle of neckline and the loss. Let me show you example on the chart. At this point the market made a low. Prior to this low, the market was in a downtrend. The market came down and retested this low, made a second low, a second bottom, and there are two bottoms, that's why we call it double bottom. This is the neckline, and as I said, our entry will be above the neckline, or we will trade the neckline on the retest as the market retested it here. Our stop loss will be in between the neckline and the bottoms, and we can trade at least the size of the double top for the double bottom formation, and we can even extend it to the highs and lows on the market. So now we will move toward the head and shoulder pattern. Head and shoulder pattern is also a trend reversal formation, and it completely turns the trend from uptrend to the downtrend. Let me show you its simple illustrations. Here we are having a head and shoulder pattern. This is the left shoulder, this is the right shoulder, and in between the shoulders it is head of the pattern. At this point it is the neckline, and our entry order will be below the neckline. Let's say here we will trade it in three ways. First of all, we will put our entry order below the neckline. The second way to trade it is to enter on the formation of the second shoulder, and the third way to trade it is to enter in the market at the retest of the neckline. Let me show you its example on the chart. So here we are having an uptrend, and here the market made a high. The market went beyond it, made another high, which is the head of the head and shoulder pattern. The market made a neckline for the head and shoulder, and here we are having another shoulder. So it is a complete head and shoulder pattern, and as I said, we would have traded it from the second shoulder. We would have set our target, our entry below the neckline, or the third way we would have entered at the retest at this point. So the drop will be of the same size as the formation of the head and shoulder pattern, and the pips from the neckline to the high of the head. This will be our first target. The second target we can set is we target a low, a previous low on the chart. So that's how we're gonna trade the head and shoulder pattern. Now we will move towards inverse head and shoulder pattern. It is the opposite of head and shoulder, and it is also a trend reversal pattern formation, it appears at the bottom of a downtrend and it completely changed the direction of the trend. So let me show you its illustration. Then I will show you its example on the chart. Here we can see it is the first shoulder. It is the head of the pattern, and at the right we are having the second shoulder of the inverse head and shoulder. This area is the neckline. So the market will go as much as the formation of the inverse head and shoulder. Let's say the market has moved 60 pips from the head of the inverse head and shoulder to the neckline. So the market, our initial target will be exact 60 pips. We can trade it in three ways. First, we trade it from the second shoulder. Second, we set an entry above the neckline. And third, we trade inverse head and shoulder on the retest of the neckline. So that's how we're gonna trade the inverse head and shoulder. Let me show you its example on the chart. This is the example of inverse head and shoulder. The trend was a clear downtrend. The market made first low here, then broke it, made another low, which is the head of the pattern, and again the market made a second shoulder. The first one was this one. This is the head of the pattern, and this was the second shoulder of the pattern. So let's zoom it out a little. This was the pattern. This was its neckline. So how would we have traded it? First of all, we would have traded it from the second shoulder formation. Second, we would have entered at the breakout of this neckline. And lastly, we would have entered at the retest of the neckline. So our target would have exactly is the formation of inverse head and shoulder. This should be our first or initial target. And you see, whenever such patterns appear, it completely hit its initial target, which is the size of the pattern. And lastly, we can extend it to the highs or lows on the chart, the previous highs and lows. So these were the examples of double top and double bottoms, head and shoulder and inverse head and shoulder. Now we will move towards the wedge patterns, which are the rising wedge and the falling wedge. So first I will be discussing the rising wedge. First of all, I will show you its illustration and later I will show it to you on the charts. Wedges actually signal a pause in the current trend. When you encounter this formation, it signals that Forex traders are still deciding where to take the pair next. Wedges could serve as either continuation or reversal patterns. So let me show you the illustration of the sloping support resistance. Rising wedge is formed when price consolidates between uptrend sloping support and resistance lines, as it is shown in the illustration. When rising wedge forms in uptrend, it is bearish reversal pattern, and When rising wedge forms in a downtrend, it signals continuation of the downtrend. As we can see in the illustration, the price action is squeezing in between the sloping support and resisting points. So, the formation of the rising wedge will be our target. When the breakout happens, we will target the exact amount of pips as it has took to form the rising wedge pattern. Let's say the rising wedge pattern has formed in the area between 80 to 100 pips. So we will target the same amount of pips once the breakout happens. Let me show you the example of rising wedge on the chart. So here we can see the market was in an uptrend. The price action squeezed between these 2 points, between these sloping support and resistance. So as I said, we will target the area, the area where the rising wedge has formed. Let's say the rising wedge formed here between, it took 110 pips to form this rising wedge, and once it broke, so let's say we will be targeting the exact amount, which is 110 pip. You can see it easily accomplished that level and hit the target. You can see the trend reversed after the formation of rising wedge. Now let's move towards falling wedge. So this is the simple illustration of falling wedge. Here we are having sloping support and resistance points, and the market is squeezing between these sloping support and resistance points. So whenever the falling wedge appears in a downtrend, it is a signal that the trend is about to reverse into an uptrend. And when falling wedge appears in an uptrend, then it will serve as a continuation pattern. So how to trade it? The best way to trade it is to set our entry, our pending order above the sloping resistance, or the second way we can trade it on the retest of the high, the previous high, which will act as a support now, or on the retest of the trend line. So these are the two ways we gonna trade rising wedges and falling wedges. Now let me take you to the charts to show you how it appears and how it works. So that is how falling wedge appears on the chart, squeezing between the 2 points, the sloping support and resistance. And as I said, we would have traded it in two ways. First, we would have set our entry above the sloping resistance here, and secondly, we would have traded it on the retest at this point. So as I said, we will target the exact area as there formed the falling wedge or the rising wedge. So it could have easily achieved the targeted profit, and this should be our initial target. Then lastly, we can target the previous highs too on the chart. So that is how falling wedge and rising wedge works in the market. Now we will move towards the triangles. In the markets, there are three types of triangle. The first one is symmetrical, The second one is ascending triangle, and the third one is descending triangle, and we will discuss them all in this video. So let me show you the illustration of the symmetrical triangle first. This is how the symmetrical triangle looks. The price action is squeezing between the triangle. So after the formation of this pattern, price action can move in either ways. It can move upward or it can move downward. And whenever the price action breaks this triangle, in either ways, it will not look back and will travel in that direction. But we will target as much area as the triangle has occupied to form. Let's say the triangle is formed between this much. The triangle is formed between 100 and 150 pips. So it will move 100 and 150 pips to when the breakout happens. So it can move in either ways. Let me show you its example on the chart. So this is how symmetrical triangle looks on the chart. We can see the pattern formed between 120 to 130 pips. So we will target this much pips too once the breakout happens, and the breakout happened to the upside, and you can see the market could have easily achieved and hit our target if we would have took our entry at the breakout point. So after the formation, after the breakout, it is unlikely for the price to retest the trend line or the triangle. So the only way to trade it is to set the entry above or below the triangle. And as we just said, it is a bilateral pattern. The market can move in either ways, so we will be not biased. We will set our entries below the triangle and above the triangle. Now let's move toward the ascending triangle. So this is the illustration of ascending triangle. In the ascending triangle, we are having resistance and a slope of higher lows. These are higher lows, and above we are having resistance. And we will target the exact amount of pips once the breakout happens. As amount of pips as the market has took to form this ascending triangle. Let me show you the example of ascending triangle on the chart. So as I said, we are having resistance at the up point of the triangle, and we are having the slope of higher lows. So as I said, we will target the exact amount of pips as it took for the market to form the ascending triangle, and it will be our initial target. And the second, we can target the previous lows of the market once there happens a breakout in the ascending triangle. So I am showing you simple illustration and the example of these chart patterns on the chart. So now we will be moving toward the descending triangle. So this is the illustration of the descending triangle, which is the opposite of ascending. Descending triangle occurs when there is a support and a slope of lower highs. This is the illustration of descending triangle. Now let me take you to the charts to show you its example on the chart. So this is the example on the chart. This is a descending triangle as we are having a support and we are having a slope of lower highs. So as I discussed, it is a bilateral pattern and the market can move in both of ways. The market can move in uptrend, the market can move in downtrend once the breakout happens at descending triangle. So here we would have set our target, our entry below be targeting as much amount of pips as much it took for the market to form the descending triangle, and it is about 65 pips. So this would have been our first target, and as I said, we can set second target is the previous lows on the chart. So this is how we gonna trade symmetrical triangle, ascent, descending triangle. So now, as I discussed and showed its illustration and example on the chart, so now we will be moving toward the pennants. We are having two types of pennants. One is bullish and the other is bearish. Let me show you the illustration for both bullish and bearish pennant on the market. Once it appears, the impact will be huge. The pennants appear in a clear downtrend and in a clear uptrend. You can say these are small triangles that appear in clear trending markets, small in size, but they can signal huge price moves. This is the example of bearish pennant on the chart. You can see they are small in size, but the impact is very much on the market. So now you will be having questions in mind. How much area we will target after the formation of the pennant? We will target the area. First we will gauge the move prior to the formation of the pennant. Like here it is about 75 pips. We will target the same area, the same amount of pips, and the market will be more likely to hit the area. So here you can see this is the example of the bearish pennant. Now let me show you the example of a bullish pennant. This is the example of the bullish pennant. The reason we call it bullish because it is a continuation pattern and it appeared in a bullish trend and it further extended the bullish trend. The move we will gauge. So we will gauge the initial move before the formation of the pennant, that is about 150 pips, and we will target as much amount of pips after the formation and after the breakout of the pennant, which it achieved quite easily. So we will trade it. We will set our entry above the pennant of the bullish pennant, and because the market never retraces back to the to retest the pennant, so we will be setting entries and pending orders, and we will set an entry below the bearish pennant. So that's how we're gonna trade the pennants. And now we will be moving toward the rectangles. There is no bullish and bearish rectangle because whenever the rectangle appear, the market can move in either direction. It can move upward and it can move downward. So let me show you its illustration. So basically, as we can see, the market moves between 2 points, which is support and resistance. This is how a rectangle looks. But don't be panic, I will show you what happens when the rectangle breaks to the upside and when the rectangle breaks to the downside. So how we will trade it? The first way for us to trade it is to set our entries, our pending orders below the support and above the resistance. The second way to trade it is to trade it on the retest of the support when it breaks to the downside and when it breaks to the upside. Then we will be waiting for the retest of the resistance and then we will enter. The market will move 100%. The market will move this much. Like let's say the market took 100 pips to form a rectangle. The rectangle formed in between 100 pips. So we will target exactly 100 pips to the both sides. So that's how we're gonna trade the rectangle. Now let me show you the examples on the chart. You can see we can call it bullish uptrend and there formed a rectangle. The market moved between 2 points between support and resistance, and once the market broke the rectangle to the upside, it came down to retest the previous resistance area or to retest the rectangle pattern. So this was the point where we would have took the entry and our initial target would have been this much, and later we can target the previous highs once it breaks to the upside. Now let me show you when it breaks to the downside. So this is the example of the rectangle that broke to the downside. For the rectangle pattern we will need at least 2 support points and 2 resistance points. So we can see the market broke it to the downside and the market came and retested the rectangle. So our initial target will be the target, the pips it took for the market to form the rectangle. Here it is 55 pips. So this way we will gauge the market and this will be our first target. We can extend our target to the previous lows too. And how to place stop loss. So the best way to place stop loss is to place it in between the triangle at the 50% level of the triangle, and it is less likely to be triggered. So that's how we gonna trade rectangles. And lastly we will move towards the bullish flag and bearish flag. So let me show you the illustration of bearish flag and bullish flag. At the left we are having the illustration of a bearish flag, and at the right we are having the illustration for a bullish flag. They both appear in a clear uptrend and a clear downtrend, and they both are continuation patterns. Let me show you its example on the chart and let me show you how to trade it properly. This is the illustration of bullish flag, and as I said, the trend is uptrend, and there appeared a bullish flag, and once the market broke it, it went completely to the upside. We will target the exact amount of pips, and the exact move happened prior to the formation of bullish flag, which is, let's say, 750 pips, 650 pips, and here this will be our initial target to 650. It even went below the target level and went somehow towards 1000 pips. So how we will trade it? We will place our stop loss below the sloping support, and we will place a pending order and entry above the resistance level. So when the market will break it, it is unlikely to retest this bullish flag. Now let me show you the example of bearish flag. This is the example of bearish flag on the chart. As the trend is down, the market moved almost 90 pips, and once the flag formed and the market broke it to the downside, the market moved exactly 90 pips. So this is how we gonna trade the bullish and bearish flags. In the bearish flag example, we will place our stop loss above the high, and we will place our entry, our pending order below the resistance level, below the trend line. So when the market will break it, the market will be less likely to retest this flag. So it was all about chart patterns today. I hope you understood it. I will recommend you to backtest these chart patterns, practice it, and once you get trained enough, you will be able to squeeze as much profit from the market as possible.